Hello and welcome to the World Built Environment Forum webinar series. This webinar looks at de-risking green finance. What are the risks that fund issuers and investors must deal with as they look to step up their sustainable performances in line with SDG criteria? And how do we mitigate those risks? At the end of this webinar, we'll also be showing you a discount code for our forthcoming summit, which is taking place in Shanghai in May. I'm John Krause from RICS, and we're joined for this discussion by four industry leaders. So in no particular order, Ted Chapman, Senior Director, S&P Global Ratings. Welcome, Ted.
Very good, thank you, welcome.
Katie House, Analyst in Verification and Impact and at Affirmative Investment Management. Hello, Katie.
Hi, thank you.
Sean Kidney, the CEO at Climate Bonds Initiative. Welcome, Sean.
Great to be here, thank you.
And finally, Michael Duran, who's partner at Baker McKinsey. Hello, Michael.
Hello, thank you very much, John. Thanks, great to be here.
Okay, so that's our panel, and we'll be getting on in just a moment. Before we start, I'll let you know as listeners that you can submit questions via the question box online, and we will try and put your questions to the panel as we go along. And indeed, at the end of the session, if we have time, we'll also do a bit of mixed Q&A. So let's get underway. Let me turn first to Sean Kidney. Sean, in your role, you're mobilizing debt capital markets for climate solutions. So from what you see in the markets, why are green bonds in demand compared with what we might call a traditional bond?
Well, the background is a growing awareness, especially on the part of asset owners and now their fund managers, about forward risk of climate change. You'll be aware, and hopefully our listeners will be aware, of the extensive discussion in the last few years about policy risk, about impact risk. I've just come back from a couple of weeks in Australia where I can tell you the impact risk is real. And I note that Moody's put out an interesting report on potential forward sovereign risk for Australia in the light of climate change. These are palpable concerns for matching assets and liabilities over the long term. The challenge is, what can investors do about this sort of stuff? I mean, you've got a pretty general view across the institutional investment community. We have a challenge. We have a challenge also guessing what governments are going to do. But there is now no doubt that there is already, and there will be a lot more state action. It's merely a time frame and how states are going to react. So there's the risks. How do we address these? Well, one of the ways we address is we look for things like carbon risk, and that's what the Task Force on Climate Finance Disclosure has provided some guidelines about, and now in Europe that's becoming a regulation. And we also look at what sustainable investments we can make that might mitigate some of that risk. If you're investing in a company that has a lower exposure to the transition risks or the policy risk coming forward, then chances are that's a lower credit risk going forward, and that's a fairly common narrative. That's how the green bond market is being fueled, that perception of risk and mitigating that risk, which has been fueled by many discussions by central banks around this too. And the first report on the insurance industry that the Bank of England, insurance regulator, put out, talked about the potential role of green bonds as a risk mitigator, in the sense that that's signaled organisations that were taking some sort of action. And you actually see some real effect in the European market, at least, on the share price of companies that issue green bonds. Investors seem to be saying, okay, people who are issuing green bonds are possibly lower risk, and so therefore their share price goes up, and there's now a significant statistical correlation between share price bounces that are maintained, price stays up, and the issuance of a reasonably substantial green bond. That's the background to it. Of course, as we all know, it's not a silver bullet solution, a green bond, but it's a starter pack for what investors can do. It's a way of engaging, and of course it engages the largest asset class in volume. On the back of that, all sorts of other things happen.
Great. That's a great introduction into what the attractions of where green bonds was, and the effect on share price. Clearly, that's very interesting and powerful and attractive for people. But a lot of what was being said there was really around mitigating risk and the downside. It was making green bonds sound a little bit like something we're doing because we have to do it rather than we want to do it. I wonder if any of the panelists want to expand on the reasons why green bonds are becoming popular, and what in the market are you hearing that's making them sound not just like a risk mitigator, but as actually an attractive investment? Who would like to come in on that?
Sure, John, this is Ted Chapman. I think in addition to the virtues associated with, the economic benefits, addressing risk management vis-a-vis climate change, I think that there's economics behind it as well. You can look at maybe kind of the quote unquote market forces. You, as an issuer, would potentially attract a larger, more diverse pool of interested investors. Maybe that has a beneficial impact to your cost of capital. And certainly, I mean, again, with the focus on green finance being associated with like internal benchmarking, greenhouse gas reductions, fossil fuel usage, maybe that's being displaced, et cetera. There's also this heightened level of externally focused transparency and reporting. And all of those things I would view as beneficial to stakeholders, to interested parties. And certainly, I think there's been, traditionally the approach is that maybe investors are looking at ROI, preservation of capital, as still being their particular main strategies, main drivers for risk tolerance, for, just kind of strategy overall. But I think certainly environmental related impact investing, it's clearly among the fastest growing strategies over the last decade or so. 2019, I think it was estimated around 230 billion US in global green bond issuance. That's a tenfold increase just from like 5-6 years prior. So there's more of it out there, there's more awareness. And I think, again, the more potential suite of investors that you might bring to the table, again, market forces could only have a beneficial impact to your cost of borrowing.
Okay, wonderful.
I feel, Ted, you're looking for a changing the world feel about this, and there's no doubt that that's what many of us are doing in this market to try and promote it. But it's important to note that our institutional investors have a significant regulatory framework they have to operate in, and so their ability to be able to take risks to save the planet is limited as much as I'd like them to do more. So unless we couch this in terms of risk mitigation and remember that in bond investments, it's all about making sure your capital is protected much more than getting yield out of it. Now, Larry Fink says that he didn't make money by giving people yield at BlackRock. He made money by making sure they didn't lose their money. And so in that context, this issue of risk protection, risk mitigation is an extraordinarily powerful line of argument to get the $100 trillion institutional investment market moving. Now, it also, by the way, happens to help create a future for our children, which is important. But unfortunately, the way we've set up our regulatory system for institutional investors doesn't really allow that to be a powerful argument for how we do it. It's the protection of capital, which is real and material, which is the line of attack. And that's really why the market's moving. And so if you want to pitch as an issuer, you have to be aware of that particular driver and how what you're doing will be important for capital protection for the investors.
Thank you. That's a really good extra aspect. And I think we'll be able to come back and explore that a bit more in the subsequent questions. I want to bring Katie in at this point, if I may, because Katie, you're working on verification and impact. So can you tell us how green bonds are being used to actually improve the sustainability performance of the built environment?
Yeah, thanks, John. So I just wanted to start off by mentioning a bit that buildings and sort of issuers and green bonds with proceeds going towards buildings do make up quite a sizable percentage of the green bond market. Affirmative, about 20% of our funds are invested in buildings related projects. I know that Climate Bonds Initiative tracks the market as a whole, and their figure is that I think in 2019 about 30% of use of proceeds from green bonds went to the building sector. So I thought it was just helpful to show that it is one of the big sort of percentages in the green bond market, and we do see quite a lot of projects coming through that have got a building aspect to them. I think over time we've been seeing an improve in we've been seeing green bonds and the kind of disclosure around what the eligibility of your project is for a green bond improving. So to begin with, a few years ago, you saw the issuer would be referencing different certification schemes. They wouldn't necessarily be saying it had to meet any kind of level of certification. So they might mention BREEAM or LEED, but they wouldn't be mentioning that it had to be sort of platinum or gold. They'd just be mentioning that it did have a certification. As we've seen more green bonds coming out in this space, I think the market has kind of been able to understand what is best practice and what is the practice that they should be expecting. And that's been helped a lot by things like, well, most recently by the EU taxonomy. So I know Sean can speak more to that. But that in June they published the draft criteria, and that includes buildings. And so now we have these kind of market norms where if a bond is issued and it's got buildings in the proceeds, and it's not hitting those kinds of thresholds that we'd expect, so that can be around the higher levels of the certification schemes, or it might be a percentage of energy efficiency improvement. So we're generally looking to see that the energy efficiency of a retrofit achieves about a 30% improvement. And I'd say sort of 4 or 5 years ago, we didn't have those norms that we could really leverage, and it gives us a leverage point when we're talking to issuers to say, well, actually, the eligibility you've put on your buildings, that's not really strong enough. Why is it not strong enough? Can you make it go any further? And do they have any capacity to kind of like increase their performance? And I think the other point I wanted to make is, over time, we're starting to see this shift from green bonds focusing on kind of the greenhouse gas emissions performance of the building, so talking about the energy use, to now actually people are going beyond just the mitigation of the projects and actually starting to think about what about the resilience side of these projects as well. This is something we're starting to try and evaluate, and I know quite a few others are starting to try and evaluate. So not just is it a low carbon building, but actually in what are they doing? How will their asset perform in a kind of 1 degree warming? What about 2 degrees? What about 3 degrees? And we're starting to see that, and I think over time we'll start to see more reporting in that area as well, and especially if we've got more investors who are asking those questions when they're seeing green bonds being issued.
Thank you, Kate. I think there's some really interesting points there. I think you mentioned 30% energy efficiency improvement, for example, in retrofits. And if one looks at what the EU is doing with its taxonomy at the moment, to define what is sustainable activity, I think they cite a figure of 30% for retrofits as being what would constitute a sustainable investment. So that's interesting. Also interesting, this idea that we're not just addressing these issues in silos now, but moving beyond, what is the climate mitigation impact of an asset towards what's its performance in a scenario where it needs to be more resilient. And I think this really brings us very nicely on to the next question, which is really about key risks. So Ted, you've done a lot of important work at S&P in the field of rating criteria. So compared to other bonds, what are the key risks that one experiences with a green bond that perhaps one wouldn't see in non-green bonds?
I think ultimately, very broadly speaking, it boils down to management's willingness to commit to, all of the key facets that are aligned with green bond principles, whether you're talking about the upfront independent verification, certification, the greenness, so to speak, internally segregating and tracking proceeds, the ongoing commitment to disclosure and reporting. I think that there's generally accepted uniformity. Certainly the US is not at the same degree as Europe is, obviously, but I think we're getting better, at least as far as consistency towards benchmarks, towards metrics. But I think that all boils down to the willingness of management to be able to commit to that on an upfront basis and an ongoing basis. As an example, kind of to the contrary, municipals in the US provide a good bit of infrastructure, generally speaking, roads, bridges, utilities, and so forth. Many of them are a little bit hesitant to commit to those costs. They cite tight budgets, perhaps that's not their perceived best use of shared dollars and resources via taxes and so forth. So we've seen a little bit of hesitance. There's no regulatory push for it yet. The environment, at least at our sovereign level, is probably not commensurate with mandates yet. That could change over time. I don't know. But I think at this point, it's got to be just sort of voluntary. And we're seeing some that maybe are geographically more situated to, this is within our wheelhouse. We feel that this is an appropriate use, appropriate plan of action. Not everybody's willing to make that commitment, whether you're talking about local and regional governments, whether you're talking about corporations. It's been very much case by case basis. There hasn't been kind of a broad trend or broad swath of a gentle push to move in that direction with uniformity.
Thank you. So this then leads me to think, how do we, do we need some standardization? Michael, you're dealing with risk all the time in your role. Do you think we can, and if so, how can we achieve greater standardization in assessing what constitutes a green project to try and give the levels of confidence that would get over perhaps the hesitance that Ted was just talking about?
Well, let me, thanks, John. Let me just come back, if I can, to just one or two of the points that Ted make, and then I'll make a few comments on standardization. I think Ted completely correctly identified sort of execution and process of a green bond as part of the risk from an issuer perspective. And I think I look at this, and lawyers tend to look at this from the perspective of both there's issuer risk and issuer assessment of the green bond, and then the investor assessment of the green bond. And when we talk to treasurers or CFOs or CEOs who are considering a green bond, they want to know what's the advantage or disadvantage against doing a green bond as against a plain vanilla Eurobond or bond issue. They recognize quickly that there are no tax advantages to doing the bond issue, and they recognize quickly that currently there are no obvious differentials or pricing advantages to them in doing a green bond. So as to pick up Ted's point, it is a question of engagement, willing to commit management time, willing to commit to deal with third parties and parties with whom they do not usually have to engage when they go into the international capital markets to raise cash. So that commitment is quite key, and it is the risk that presents to them is a timing risk. It's a window of opportunity. It's, will the markets move against them? Will they consider doing this? So you're trying to manage their expectation, their timing expectation, and what is achievable. The only other risk, just on that point, is from an investor perspective. And just to be clear in this, I think there is a risk for investors in certain green bonds, and I think the risk is just that of contractual certainty, and the fact that investors, the potential problem of greenwashing, and the potential problem that green bonds will be used not for the stated purpose, not for what it says on the can, but for a different purpose. And their investors have a slight problem because most green bonds don't give them the contractual right to react to that. John, sorry, you on the question of standardization, and I'll probably come back quickly to one or two of the other panelists, because there are sort of a cacophony of groups, industry associations, regulators trying to establish a common language for the sustainable project, the sustainable finance project. Sean and others and Katie have mentioned the EU taxonomy, massive working project which has been running for the last year, essentially to establish a common language for this whole sector so that people are communicating with each other on terms which are commonly understood. The TED and the rating agents have a key role in this as well, because the rating agencies, S&P, Moody's, and the others are all trying to assess bonds to confer green ratings on bonds. And then yesterday at Davos, we saw the World Economic Forum produce the first, as far as I'm aware, the first sort of collective effort by the big four accounting firms to establish a sort of common metrics for consistent audit reporting. All this is geared to try to create a standardization, a common language, so that people can understand, investors, issuers, all market participants can understand what we're talking about.
Thank you very much. So would someone else like to come in and add to that? Because clearly it's a very complex and certainly very emerging theme about how you bring common language to the world of green bonds.
Well, it's Sean here. Look, this has been a core part of our work at the Client Bonds Initiative for the last 8 years or so, and we've been a key participant in the development of the EU taxonomy, support of the Chinese, their taxonomy, and we also have a certification scheme. So I'm a bit of a biased view, I will say, but the line we run is that bond markets, financial markets need commoditization to grow. We're unlikely to get to the kind of scale of markets that we need with bespoke approaches, with the need for issuance by issuance examination in detail. The sooner we can get to common languages, the faster the market will grow, and our own view is we need to see trillions of green bonds, or bonds that are effectively green, whether they're labelled or not, in this market before we can get a signal that we're maybe moving adequate money to address the challenge. So trillions. So that's the background to it. Like any complex challenge, of course, the objective is to do exactly what we do with a motor car. We want people to be able to get in, put the key and drive. That's where we're going to get to. But there's a lot of engineering work to get there. It is complicated. We've been working on the taxonomy for actually a year and a half, the EU taxonomy. And of course, the work that CBI did in the previous years has been fed into that. So is the work that development banks like EIB and others have been fed into that process. So it's drawing a lot of other work. It is a huge task, there's no doubt about it. But the benefit of it is, when you get to the end, you have what is essentially a procurement plan for Paris. And that's what we're getting to. And our investors and issuers and governments, because member states will be working on this in Europe as well, now have a very clear view and understanding with someone else has done through a science-based process. I want to stress that this is about translating the science. It's not about policymakers inventing this. Through the process, there's something that has a lot of confidence. The people can have a lot of confidence in is a reasonable guide. There are always boundary issues because, of course, in financial markets, you need a relative degree of binary approach, or in fact, effectively coming up with what is an investment grade baseline for what's environmental if you want to look at the Paris Agreement. And then, of course, the services the likes of S&P provide in their green rating system can then provide the shades of green above investment grade for the purpose of investors. That's the way we're looking at it. So it's complicated, but if you want to grow the market fast, it's necessary. And it's also necessary when people do not understand, because a lack of access to the science, what the implication of what the IPCC reports are, what the IEA, International Energy Agency reports are saying in different sectors. So in buildings, the clear lesson is 5% improvement in energy efficiency does not qualify, nor does a 15%. You have to have ambition, because we need to achieve something like 40% of our reductions in emissions to meet the Paris Agreement have to come from the built environment over the next 30 years. And so if we're only doing 5 to 15% emissions every time we do a renovation, we're not going to get there. We have to have ambition. So what the EU taxonomy is very much looking at what the science says about the necessary ambition and working backwards to what that means targets and thresholds, including declining thresholds. There are dynamic targets, transitions, if you like, mapped out in this. and then saying, okay, from an environmental perspective, this is what counts. If you're an investor concerned that your investments are material to addressing climate change, here's a rule set. And now, of course, we've got the other job, which is not part of the taxonomy, it's part of governments, of how we actually translate that into energy policy and so on. And that's where the European Green New Deal comes in, which is probably the most advanced big economy climate action plan to date. But there are variations of this in multiple countries. So it's a secondary process. It makes it easier. You know, we don't need to have this discussion now as to whether a shale gas investment in Texas is sustainable or not, from the point of view of a European investor at least, because the taxonomy's looked into it, provided a rule set, and if it appears in the market, you can quickly check whether it meets the European taxonomy. Bingo, I'm allowed to call it sustainable and green. And that's the way we think we can grow the market very, very fast. It's got to be way, way bigger than where it is now. Katie's AIM fund has got to be way, way bigger as part of that. Does that make sense?
I think that's very clear. I love this idea of a procurement plan for Paris, and I think really important talking about the taxonomy there, how it's based on the science. It's up to the politicians.
John, can I add a couple of?
Yes, I was going to bring you in, Katie. Yes, I absolutely can. I was about to bring you in because I was also about to direct the next question at you, which is about how you then measure the actual performance of buildings.
Okay, yeah, I can mention
risk of transparency. So please, the floor is yours.
Thank you. Yeah, so just on the standardization point, I just wanted to add a bit from my perspective. So so one half of my job is the verification of, so looking at green bonds when they're just about to be for sale to work out if we want to hold them in our fund. And in the course of sort of a couple of weeks, I can be looking at proceeds that are going to buildings, renewable energy, agriculture. We recently have even seen some stuff around mining. I'm looking at something on fisheries at the moment. We see a real diversification in the market, and more so each year. And so for me, having some kind of standardization to sort of, it gives a kind of line in the sand, and it's a really useful reference point to understand. So in the buildings example that Sean mentioned, I mean, to understand what is ambition and what do we need to be seeing and what should we be seeing, and what is really actually just an incremental change that really hasn't taken them much effort to do at all, compared to what is actually ambitious and is actually aligned with achieving the Paris Agreement. We do other analysis as well, and we tend to look a bit deeper, but having those rules in the sand that we can reference is really helpful. And actually standardization is actually helpful from a kind of reporting point of view as well. So at the moment, according to the Green Bond Principles, issuers have to commit to do annual reporting to show that the proceeds of their green bond are still aligned with the framework that they originally issued when they issued their green bond. Most of them now combine that with impact reporting as well, so they don't just say where the proceeds are allocated. They also give some impact metrics to show the impact that those projects have had. And the impact reporting at the moment, it varies hugely between different issuers. So some will report quite a few different metrics on that. So when you're thinking about buildings, they might report their energy usage, they might report their GHG emissions, they might report avoided GHG emissions, they might also report water usage and water saved, and then others will report maybe one metric. And there can often be not much commonality between metrics. So having a standardization is in that regard, so not just in the kind of ambition, but also in the regard of saying, actually, these are the kind of metrics that are expected to be reported, and these are the things that are useful to be reporting, is really helpful for us to be able to understand whether the green bonds are delivering the impact that we want them to as a dedicated impact investor. That really helps a lot.
Thank you. And would any of the other speakers like to come in on that point? I think this is worth exploring a little bit more.
Well, I think John, it's Michael here. I think just coming back to and again, I think we distinguish between measured performance and ensuring that you have the correct performance. The measuring of the performance, as Katie says, is relatively complex, but that's what environmental experts do, and that's you try to get the right results. Ensuring that proceeds green projects comply with what has been financed, with what people have agreed to sponsor or partake in. Again, it's fairly simple from the legal perspective. You bring it back to what's in the underlying arrangements, what are people complying to do, what are they undertaking to do, and in the classic ICMA green bond principle world, that's a use of proceeds type arrangement, and they then notify and provide annual updates on how the money's been used. I think it does lead one into the green bond market. Without wishing to digress slightly, the green bond market is balkanizing slightly between the classic ICMA style world, where it's use of proceeds driven, and then some of the recent sustainability linked bonds, which are less contractually onerous on the company and more target driven, and that was really the Enel sustainability linked bond of last year. So I think to me it's a question of measuring against whether you classic sort of environmental measurements, or whether you use a contractual stick in the bond market. And just coming back to one of Sean's earlier points about bringing the force and might of the bond markets behind all this, simplicity and contractual certainty is what the bond markets investors adore. That's what they like. Anything that becomes overly complex or complicated, they move on to the next investment relatively quickly.
Michael, while you've got the microphone, I wanted to bring the next question to you first, which is, and you started to touch on the legal and regulatory issues, because it certainly seems to me, at least what I hear and see, that the whole issue of environmental issues is becoming increasingly justiciable, and you can find yourself in court if you've said my bond is green and it turns out not to be, and that clearly is a risk, I guess, principally for those that issue the bonds. What can you tell us about how the trends you're seeing in the legal landscape in regards to green bonds?
Well, you touch upon a very interesting point, John, in that question, because I think one of the perceived weaknesses in the classic green bond formula, following the ICMA green bond principles, is the lack of contractual bite if proceeds for a green bond are used for other purposes. Ultimately, as currently framed, there is great reputational risk for an issuer in misusing funds. But as long as that issuer continues to service the bond with payments of principal and interest, then the investor has no underlying contractual right to sue or pursue the issuer. And the problem there is that investor may be compelled, because they're subject to their own investment criteria, to only invest in green bonds. If the issuer misuses the funds, then that investor can be compelled to quickly sell the bond in the secondary market. So there are one or two what lawyers would perceive as one or two flaws in the model, as it were, which, if they can be ironed out, I think would bring force of the bond markets more fully behind the whole project. In terms of the legal and regulatory environment generally, look, bonds, and I think Ted and all the panelists have touched upon this, these green bonds are pretty much like most other type of bonds. It's really the proceeds, it's really where the money is going, how the money is to be used, and what is the environmental or climate or other benefit of the bond. Other than that, I think the legal legal issues are now coming more on the buy side. And again, I will distinguish between sell side and buy side. Sell side, they just have to worry about the corporate approvals and their general compliance with securities laws. The buy side are coming under a bit more pressure, especially in the European Union, to justify what they're buying. They're coming under more notification and reporting obligations, general ESG, and then a sort of a breakdown of ESG into green as well, to say what they're buying and what they're holding. So I think the obligations for asset managers in the buy side are changing slightly. All this is clearly set against the whole panorama, the whole framework of the EU new Green Deal and the changing dynamic and momentum around sustainable finance generally. But the legal framework is relatively straightforward.
Thanks. Actually, I think I learned something there, because I would have thought the legal issues were more on the issuer side than on the buyer side. So I wonder who else would like to come in. Do they agree with what Michael's just said? Is that the pattern that they're seeing too?
Yeah, John, this is Ted. I mean, I think that there's always, I completely agree with Michael. I think that there's always the potential for maybe sort of that self-labeling or self-representation of ours as a green bond, and then you have something that potentially stretches the credulity of, is this really green or not? And then somebody, a market participant, market observer, takes that particular example and generalizes it to the entire, well, but gosh, now there's greenwashing. See, they're setting the bar too low. We the regulators, we the politicians or whomever should establish some kind of regulatory framework. Doesn't it really so much exist here in the US yet? I think we're certainly supportive. I mean, the taxonomy, even if you just revert to the SDGs and just say, well, gosh, maybe make this a broader argument towards ESG very broadly. I think that that's at least some kind of baseline would be better than nothing, because there is the potential for, I guess, a cynic to say, why doesn't there exist more, parameters and narrow definitions? But I mean, again, there's, at least in the US, the counter argument is, well, but if I'm going to be doing something in line with green bond principles, I, the issuer, have extraordinary additional costs, ongoing and upfront. So, I mean, I wish I knew a perfect solution, but I mean, again, the US is a bit behind EU, admittedly, as far as just sort of the overall framework and approach.
So true. In fact, it's extraordinary the extent this is not taken off in the US corporate market in particular, although the muni market is buzzing with green bonds. Unlike in other countries, even Japan, it's one of the mysteries I have. The argument that's been put to us by US market participants is that litigation fear is, let's say, somewhat heightened in the US economy versus other economies. And so these self-assertion aspects of most green bond issuance, which just uses a second opinion, are fraught with risk. That is that you're essentially putting out a bond and saying, so this is what I think is green. In that argument, then putting out a bond in a regulatory environment, which is what Europe is in the process of creating, would reduce that risk, that liability risk for issuers in an American-style market. Equally, they could use certification, as in the muni market, the larger actors have started doing, like New York Metropolitan Transit or San Francisco BART, which in a sense is saying, look, don't trust, we're not saying it's green. They said this stuff's green. We're just saying we comply if these guys' crazy climate change taxonomy, the Climate Bonds Initiative, for example, or could be the European taxonomy. And that could be a liability risk mitigant in the US market to get it going. But clearly, there's something special about the US market compared to most major markets now around the world. Just picking up your other comments, I want to say the sort of caveat emptor approach has actually been okay so far. We've seen, some marginal arguments, as you'll be aware of, Repsol. I can think of a few others, but there aren't many. That the market has reasonably worked. The challenge is if you're going to grow it very fast. And, if you look at the only green defaults that we think we've seen in the whole market in the last 10 years, It was actually a Syracuse, New York property developer. It wasn't in China, it wasn't in Nigeria, it was in New York. And this was a property developer that got a green bond tax credit under the Obama administrations. It was actually Hillary Clinton, Chuck Schumer legislation for efficient buildings. They issued a $300 million tax exempt bond. And the property developer never bothered actually doing it. They just did an ordinary bog standard, very inefficient shopping center. A journalist did an investigative report. Eventually the IRS was embarrassed at doing an investigation. The law was badly framed. By the implication of the IRS report, they simply said under the legislation, they only had to promise, they didn't actually have to do. So that was clearly a green scam. If you're interested in the green aspects of the bond, not simply the tax exempt aspects. We haven't seen others, but this is going to happen, right? Especially in the razor competitive property market, which is what we're talking about today. So in that context, we think it is time as the market grows to start bringing in a bit of cover. In markets where we don't have regulatory interest in doing this, then certification is a way to provide some kind of oversight and clear identification for investors. In markets where governments are starting to look at incentives, which is what the European market is looking at, and what the Chinese market is. The Chinese market is now full of incentives of all sorts for banks, for investors, for issuers by provincial and national government. Then you have to have regulation, because the moment you've got an artificial incentive, you've got scam potential. And that's what we think will drive the bringing in of regulation. Governments are beginning to think, okay, this could be a fiscally efficient measure they can take to start increasing investment in green solutions. A bit of regulatory guidance, at least, can help. And we have these conversations with all the securities regulators in ASEAN, with the Reserve Bank in India, with the Banxico in Mexico, who are actively looking now at the nature of the role they have to play to ensure continuing confidence in the market, that it doesn't get blindsided by some form of scam or so on, in what is still dominantly about 80% a self-declared market, or albeit mainly with the support of independent reviews, but with a nod to Ted, the client, the issuer is paying for the reviews, so there can be perceptions of conflict of interest sometimes. So we think that regulation is likely to happen just because of incentives, and that will provide the confidence going forward. I want to pick up the SDGs point too. We do think that a conflation of this market with SDGs is the way to go forward. SDGs can be seen and should be seen as part of achieving resilience of ecosystems, economies, societies, which is critically important in a century of extreme weather, which is going to happen come what may. Even at the best possible prognosis, it's going to be a century of firestorms like in Australia in the last few weeks. So therefore, the SDGs are not only important in their own right intrinsically, but also important to address climate. We're looking at extending the taxonomy, the EU taxonomy and the climate bonds taxonomy into the SDGs over the coming year as a way of providing some rigor, because as you know, there's been a bit of issuance. It's a nice starter market, although some of the issuance has been a bit flaky, I'm going to say, in terms of the nature of arguments, providing at least some stronger guidelines. It may be harder than the mitigation sector, but to support the likes of Katie at AIM, providing some guidance to issuers on what they can do. And then you end up with a large and liquid market. Very important for emerging markets, where the bulk of issuance of this is likely to be on the adaptation, resilience, and SDG side, that mitigation, particularly in Africa. So I thought that was a good point to make. My last point, cost is overblown. Most people discover, especially in the corporate sector, that cost is less than they think when they go into it. And most treasuries who go into this process saying this is going to be horrible come out at the other end as big fans of the process. Even ones that have had no palpable direct benefit keep coming to our conferences and saying, we know this is going to work, we're sold now. So it's an interesting dynamic going here. Many of the issuers in liquid markets, like US munis or the European green bond market, say they're getting actual enough price benefit to cover their costs or a little bit more. Even the French Treasury says that at the green bond program. So I think the cost is a bit of a furphy, as long, and this is a big caveat, of course, as long as we can keep it simple, as long as we can commoditize it. If we start laying on more bespoke requirements, impact investing reports and so on, that will raise the cost and that will start making it tougher to make this market grow. So that's what we hope the EU taxonomy will support. The jury's out, of course, yet, to make sure that the transaction cost can remain low and commoditized to ensure it can grow without a material cost burden, which at the moment I think is more perception, but I've got a couple of egregious examples where the costs were very high, unnecessarily so, but largely it's reasonably okay so far.
Thanks, Sean. And I think a lot of interesting points there. They're going to relate to what can governments do. And that is going to be our last question of the session when we get onto it in just a moment. I think very interesting is idea of keeping it simple and commoditizing things, so that the increase in transaction costs is kept to a minimum. Because I think this actually feeds into a question we've had from one of our listeners, Kameshni Dinanath, who's saying, is there a big difference in terms of the cost between traditional bonds and green bonds? So, are they more expensive to put together and to run? And I think really that's a question, Ted, you were alluding to that earlier. Perhaps you can expand on that. What's the performance of green bonds? Are we able to do them in a way that the costs of them makes them means there is a price advantage to them?
Yeah, I mean, again, we hear anecdotes from issuers or potential issuers of green bonds that maybe the upfront cost, the independent verification of is this in line with the GBPs, is more potentially of a showstopper than the ongoing reporting, disclosure, and some of the other internal things that are a little bit more compulsory if you want to issue as a green bond. But I think overall, I would completely agree. I think Sean made some excellent points. I don't view that as being so materially like red flag, I just can't afford this now because I, the issuer, intend to do this as green. But I mean, again, that's to the discretion of each particular individual, whether it's corporation, government, et cetera. But I think overall, as far as performance, also to build on an earlier point, I think it might have been Sean or Michael, that, we can't really just sort of address things at the margins. You need to aim big and aim now, not later, if you're going to be impactful as an issuer. And so that's one of the things that we actually look at in our green evaluation is what is the relative impact of the project? If you're implementing a wind farm where you've already got abundant hydropower, probably not as impactful as if you're displacing fossil, if you're an energy provider, an electric utility as an example. So we certainly look to assess how impactful the project is and measured by some universally acceptable KPIs. You don't want to sandbag, if you will, and say I'm going to do X plus 1 when you could potentially do X plus 20. But I think overall, if you look at it under the vein or the lens or through the lens of like an ESG in general, there's high correlation between sort of climate awareness and just sort of like the general principles of ESG and financial performance of a corporation. I think that there was a meta study a couple of years ago that we typically cite. It was a study of studies, if you will, I think Friedbush and Basin, that said that there's a very high positive correlation between being aware of these principles, whether you're thinking about your resource chain and your inputs, and perhaps this is vulnerable, or perhaps this particular resource, we're stripping it out of the earth too fast, maybe we need to think about alternatives or something, or we should really treat people nicely, internally and external stakeholders. As an example, there's a very high correlation between management approach like that and overall financial performance, and it's generally very positive. It's something that we built on when we applied our ESG analysis into our rating reports about a year and a half ago. On the corporate side, all of our rating reports now include an additional assessment of how much is ESG embedded within the corporation, top down, bottom up, sort of externally, internally focused as well. And certainly within that E umbrella, if you will, is an assessment of, just climate impactfulness, green, if you will. How much is that tied in? And I think if the management approach is forward-looking, however you want to measure that or assess that, whether you're thinking about financially, other various different perils and exposures, climate risk, social risk, et cetera, I think that if management is thinking about that, that's going to play out in a positive fashion in the financial profile, and that can only help investors if ultimately, again, what you're looking at is narrowly focused on ROI or some kind of financial reward, aside from the climate virtues.
Thank you, Ted. And so something which really strikes me in all of that is, you know, we can do these assessments, we can have the criteria and all the rest of it, but ultimately we've got to somehow gather the data, because you know, companies can claim to be performing at a certain level, they can claim that a particular asset performs at a certain level, and you know, I just wonder, you know, from the panel's perspective, and I'd like to bring someone else in this point. Maybe Michael, this is one for you to comment on. You know, what's happening out there from a data perspective that allows these evaluations to be made in a way that is essentially that it's reliable?
Again, John, you've hit upon an absolutely key question, and I think certainly a large debate is going on currently around the sort of the lack of comparable data, and the difficulty for investors above all to be able to look at historic comparable data, to be able to figure out what is going on from an ESG perspective, and from a green perspective, performance perspective. I think people are trying to address it. Certainly there are various bodies that are looking at it, and certain agencies that are trying to get on top of it. But we're in a brave new world, and a lot of investors like to look back on a look back basis to see what historic, and because they are trained to look at historic financial performance, they approach these situations and say, okay, let's try and judge historic green or sustainable performance. And I touched earlier upon the fact that the big four accounting firms had started to try to come up with some common metrics and some common language and some common audit metrics which people could look at. But this is going to take a bit of time to implement, and then even more time to take that and then look at it retrospectively.
Thank you, and that's clearly the problem is there. The solution isn't yet there. We've got about 10 minutes left, and if there's any more questions from listeners, please do let us have them using the online tool, and I'll share those with the panel. I'd like to bring us to a final question, which I think is a very good question for kind of wrapping up many of the strands that have been raised. And really, it's, you know, what's the role here that governments can play in creating a favourable environment for green bonds and reducing risk? And what I'd like to maybe suggest is of each of the speakers, you know, what would be your top two asks? If you were at Davos this week speaking to the world leaders, and you said, okay, here's two things you can really do to transform the green bonds market in order to transform, you know, investment into sustainably performing buildings and assets. What would be the two things you'd ask them to do? Maybe I'll ask Ted to go first.
So, you know, and I think it quite depends on the asset class, the particular desired environmental impact or outcome. I mean, again, generally speaking, global markets, they're highly efficient, they're liquid. There is an argument that to some extent that those outcomes might be achieved without regulations or incentives, just by pure market forces, whether you're looking at like BlackRock's recent announcement. McKinsey put out a pretty interesting study fairly recently. But I think that there are some, at least here in the US, there are some asset classes that already have an inherent, maybe like environmental mission, environmental mandate. As an example, on the US muni side, in the United States, water and sanitary sewer provision is almost entirely a municipal endeavor, very little bit of publicly traded ownership. There is a program that's been in place about 25, 30 years It's already to date, I think cumulatively provided over 100 billion US in assistance, but essentially it subsidizes the borrowing rate. It's got to be a project that's in line with drinking water or clean water sewer provision, if you will. That's been very successful, but that's only a very small niche within sort of the greater potential marketplace. So I mean, again, it really depends on how much you want to do and how quickly you want to do it. I'm not sure what the appetite is for subsidization of corporations here in the US. I don't know that that climate is particularly. I don't know that I don't think things are aligned with achieving that right now. So I mean, again, it really depends on the asset class. Social housing, for example, that's probably a great one. You could retrofit, make energy efficiency across the board for existing assets. But for new development, you'd really, I guess the most that you would probably be able to do is put that into building codes or something. And I'm not sure that that would be impactful to the cost of borrowing or really much of an incentive. So if you want to see certain outcomes, I mean, it's a bit of a weaselly answer, but you really have to make it dependent upon a particular asset class. Maybe that's where we need to look to the taxonomy and have something like taxonomy 2.0 here in the US.
Wonderful, thank you. I'm conscious we've only got a few minutes left, so I'm going to ask Katie next. Building on what Ted has said, what would you ask governments to do?
Yeah, thanks. I think two things, just briefly. One would be to issue more sovereign green debt. So we've seen a bit. It started kind of a couple of years ago, but for example, the UK hasn't issued a sovereign green bond yet. We're hoping they might do before the Glasgow COP at the end of this year, although at the moment it's sounding like they're not so keen, but hopefully that will change before then. And then I think the second thing I would say is just if they can strengthen climate policy, then I think we're going to be seeing more green infrastructure, and green infrastructure is where green bonds really can help a lot. That's the assets that can back the green bonds. So those would be my two recommendations.
Thank you. Very clear, concise recommendations they were. Sean, what would be your two quick asks?
Well, the headline is we need to ensure that the cost of capital for green is preferentially lower across the board, everywhere. There's a wide range of things we can do to that. Come back to that in a minute. Second, we need to plan for a green future. Let's call it a future for our children, because the alternative is no future for our children at all. And that's a lot to do with urban planning and the built environment. Remember, I mentioned earlier that 40% of the emission reductions we have to achieve between here and 2050 are in the built environment. And that's not just building regulations, it's how we design the massive new cities that are popping up around emerging markets and will continue to pop up. Lagos in Nigeria is going to have 100 million people, the size of the Shanghai conurbation, by the time we get to 2050. So there's a big job going forward. Just a little bit more detail, if I may. We need forward policy direction. So when a country says we're going to get zero net carbon by 2050, that helps because it ensures for investors confidence that the trajectory of change is X, not Y, and they can start factoring in those changes. Of course, there are many minor things, swapping brown incentives for green incentives. The OECD has done a lot of work on that. We still have a big bias towards brown. Removing roadblocks for things like solar coming to the grids, big problem in Japan. In terms of the real economy issues, though,
okay.
There are, and this is the policy issues. This is policy issues, and in the property market, which is or the built environment, which is what we're concerned about on this call today, it's transport-oriented development, perhaps with some financial solutions like property value capture to finance that, but that's really critical. It's about building regulations. Europe has done very well with its near zero energy building regulations going forward, albeit patchily implemented. It's about labelling schemes. If governments can label buildings so we can understand what are energy efficient, financial markets will throw money at it. The biggest barrier in every economy we go to building a green property bond market is the lack of easily available universal labelling schemes. That's the one thing that would make a big difference in the next 18 months. And then lastly, it's about a whole lot of the supply chain issues. Concrete. if China were to mandate that all new public sector buildings had to be 70% lower concrete than is currently emissions in concrete than is currently doing, they would get that at the same, if not lower price than existing concrete based on the technologies available in the market. Governments can do that with their procurement planning and drive down emissions in sectors like that. So I say that because there is a lot of ambition potential in different sectors of the built environment that we can achieve, but it needs a very proactive approach. We don't see this in all economies yet. We need to see countries stepping up on this. We see it in some. That's the challenge for next year.
Okay, Sean, I'm going to stop you there because we're running over our allotted hour, and your 2 points became a wonderful manifesto. In fact, I do want to give Michael the last word then, and sorry to press you, Michael, but what would 2 points be that you would recommend to governments?
In brief, John, and I will probably be shouted down by some of my panelists. Look, we are facing the decade of consequences, to use Churchill's phrase. I think the governments have to move more radically, and I think they have to move more quickly. I don't particularly like governments getting too involved in the financial markets, but I think there's got to be, just simply put, I think there's got to be greater incentivization of green bond issuance and sustainable finance, both on the sell side and the buy side, just to really bring the power of the financial markets behind this project. We're on a short runway. We don't have a lot of time. There may be some attempts to arbitrage that. There may be some attempts to Sean mentioned earlier some of the problems with incentivization. I think we've got to try it.
Thank you very much for that, Michael. So that's all we have time for today. Many thanks to our experts, Ted Chapman of S&P Global Ratings, Katie House of Affirmative Investment Management, Sean Kidney of Climate Bonds Initiative, and Michael Duran of Baker McKenzie. Do let us know what you thought of the webinar today by completing the online poll. Thank you for joining us. The discount code for our forthcoming World Built Environment Forum Summit in Shanghai will be appearing on the screen in just a moment. So thank you again, everyone, for joining us. And we will be putting a recording of this webinar subsequently onto the World Built Environment Forum website. And there were 1 or 2 questions that people submitted on the online facility. I'm sorry we didn't get around to covering more of those today, but thank you anyway, and we will certainly try and include all those points in any future webinars. So thank you very much to everyone.
Thank you. Bye.
Thank you, John.
Thank you.